Welcome to Spiedel's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering the Kiddie tax and investment decisions that will reduce the child's unearned income. We covered this topic in Spiedel's Federal Tax Letter, a monthly newsletter and searchable online archive of back issues. For more information on the benefits of subscribing, go to spiedel.com and click Publications. The Kiddie tax rules are designed to prevent taxpayers from shifting investment income to their minor children at a tax rate lower than their own. The rules accomplish this by taxing a child's unearned income at their parent's highest marginal income tax rate if certain other requirements are met. Taxpayers can limit the Kiddie tax bite by making investment decisions that will reduce the child's unearned income. For example, deferring capital gains to the following year or until the child is old enough that the Kiddie tax rules no longer apply to them, or deferring gifts of income-producing property until the dependent is old enough to not be subject to the Kiddie tax rules. Taxpayers can also use tax-deferred investments, such as U.S. savings bonds or certificates of deposit or treasury, that won't mature in the current year. If the child has earned income, investments can be made for them into a Roth IRA, so the earnings are not taxable. And taxpayers can consider putting investment dollars into a Section 529 college savings account, which will grow tax-deferred, and the earnings will never be taxed if they're used for qualifying expenses. Children who meet certain requirements are required to attach to their income tax return Form 8615, Tax for Certain Children Who Have Unearned Income. If the requirements are met, the child's unearned income is taxed at their parent's highest marginal income tax rate. The requirements that need to be met are the child's unearned income has to be more than $2,500 in 2023. The child needs to meet one of the following age requirements: under age 18 at the end of the tax year, at least age 18 at the end of the tax year and didn't have earned income that was more than one half of the child's support, or was a full-time student at least age 19 and under age 24 at the end of the tax year and didn't have earned income that was more than one half of the child's support. At least one of the child's parents needs to be alive at the end of the tax year. The child is required to file a tax return for the year, and the child can't have filed a joint return for the year. In the case of parents who are not married, the tax rate of the custodial parent is used to determine the Kiddie tax. In the case of married taxpayers filing separately, the parent with the greater taxable income is the one whose tax rate applies to determine the Kiddie tax. Instead of filing Form 8615 and attaching it to their child's income tax return, parents can elect to report their child's income on their own return using Form 8814, Parents' Election to Report Child's Interest and Dividends. Parents are eligible to make the election if their child meets all of the following conditions. At the end of the tax year, the child was under age 19 or under age 24 if a full-time student. The child's gross income was less than $11,500 for the tax year. The child had income only from interest and dividends, including capital gain distributions and Alaska Permanent Fund dividends. No estimated tax payments were made for the child for the tax year, and no overpayments from the previous tax year or from any amended return were applied to the current tax year under the child's name and Social Security number. No federal income was withheld from the child's income under the backup withholding rules. The child is required to file a federal return unless this election is made. The child does not file a joint return for the tax year, and the parent is qualified to make the election because they are either the custodial parent, the parent with the higher taxable income when the parent's filing status is married filing separate, or both the child's parents file a joint return. Get an update on everything that happened during the year at Spiedel's Federal Tax Update webinar on January 4th and 5th. Register before August 30th and get a letter you can send to your business clients about new mandatory retirement plan amendments for 2024. For more information, go to spiedel.com and click Webinars. That's all for this week. Join us next time for another episode of Spiedel's Federal Tax Minute.